Hello everyone, my name is Lee DeLorenzo. I'm the founder of United Asset Strategies. I'm joined today by Matt DeLorenzo, our Chief Investment Officer, and Thomas Healy, our Chief Portfolio Strategist. As we do, we're going to talk about the third quarter, where we are and where we think we're going. And I have to say that the third quarter had a lot of chaotic news flow coming at the markets and a lot to deal with. We had the U.S. withdrawal from Afghanistan. We had the Delta variant emerging. We had policy fighting going on in Congress, where we had the debt ceiling debate, a possible government shutdown. We had inflation rearing its head in a new way. We had possible changes going on at the Federal Reserve and their policy. And we've had some ongoing inventory constraints going on at the ports. And in spite of all of this, the S&P 500 actually eked out a small gain for the quarter, although it was a very rough September, wiping out the first 2 months' gains. But year to date, the S&P 500 in terms of total return, where we include the dividends, is actually up 15.9%. And how we got there has been an actual teeter-totter or flip-flopping, continuing between sector rotations as well as style. Large cap to value, value back to large cap, and then back again, leaving pretty much the value and growth returns almost equal to each other as part of the S&P 500. But the sector rotations have been a little bit more volatile. For instance, energy's up nicely for the year, but had a bad quarter. Utilities, a laggard for the year, had a great quarter. So the flip-flopping gives United Asset Strategies, an active management firm, the opportunity to take advantage of relative values in the marketplace. So when we look at the future, we need to take into account, as we usually do, things like economics. So I'm going to kick it off to Tom right now for us to talk about the economy.
Sure. Thanks, Lee. One of the areas that's definitely been a concern for investors is the economy, and it's definitely had mixed signals. Coming out of last year's pandemic, we saw a lot of the economic data really move up significantly. PMI, Purchasing Managers Index, consumer confidence, the city surprise index, housing, the labor, everything was getting better and improving. But as we saw more recently with the Delta variant, there seems to be a correlation between the spikes in COVID and things like consumer confidence. So we saw a big decline in some of that areas. Like the PMI, for example, was at 55 in the most recent month. Now that's still expansionary, above 50, but it's down from 69 in May. So clearly we're seeing a slowdown in the economy. But what's been encouraging is over the last, say, 3 or 4 weeks, we've seen a bit of a downturn in the COVID trends in terms of the number of cases, and we're starting to see some of the economic data turn back up. Consumer confidence ticked up last month. The economic surprise index ticked up last month, PMI. So that's really encouraging, and I think that's going to continue. I guess the question becomes, will the economic strength be enough to continue to support strong corporate earnings, which has been one of the key drivers for the market? And that's still something we're watching very closely, particularly as earnings start this week.
Thank you very much. Matt, do you have some insight on what's going on with monetary policy in the Federal Reserve?
Yep, absolutely. So this has been closely watched really all year. The Fed has been extremely supportive of the economy with rates all the way down to zero, buying a lot of bonds every month. Other central banks around the world have been doing the same thing. So being that we've progressed further and further away from the worst parts of the pandemic and the market's been strong, the Fed's really been, everybody's been watching the Fed to see when they're going to pull back from this, when they're going to taper. And it's really been a challenging position for them to communicate because inflation has been very high, which gives them a reason to pull back from some of the support. But we did see a little bit of a rollover in some of the economic data, as Tom mentioned, things not looking as strong as they had been, partly due to the Delta variant. But we did get some information at the most recent Fed meeting and then confirmed again by the Fed minutes that the Fed is looking to proceed with the taper, whether it's November or December this year. Around that time frame, they're going to start buying less each month, and they're going to be looking to wind down net additions by mid next year. So what that really means is it's still a super accommodative standpoint that they're really taking, but it's just going to be a little bit less as time goes on. So it's a big deal that it's kind of a change at the Fed, but still an accommodative stance. So overall, though, interesting time to be an active manager when there's so many changes taking place and investors positioning around that. just gives us the opportunity to find some value and buy some good bonds for our clients if they show up.
We're talking about rates of return, and I failed to mention that the interest rates indices that will, the bond market indices that we most often quote, municipal bond index is actually up less than 1% this year, and the aggregate bond index is down about 1.55. You wouldn't know that with everyone being so afraid of fixed income these days, but the forecasting by the Federal Reserve has been very helpful, dampening volatility. So there's more things that are going on that affect the markets in the future. So I'm going to turn it back to Tom, where we talk about fiscal policy and what might be coming after all.
Sure. Thanks, Lee. To your earlier point about September, we'd seen a big pullback in the market, and I think a lot of that had to do with the fiscal items that were being debated in Congress. Two most prominent are the debt ceiling, which needs to be raised. It's the government's credit card, so to speak, and also the budget, which has to be renewed October 1st of every year. So what they effectively did, because they couldn't come to agreement on either, is kick the can, so to speak, in Washington talk, whereas the budget will be revised or reviewed on December 3rd, and the debt ceiling is early December, although with strong tax receipts, tomorrow's tax day for extenders, we're expecting that they could probably get into January before we violate the debt ceiling, but nonetheless, we have to revisit that again in a few months, but at least Congress was able to move it forward. The two other big items are the infrastructure package, where there's bipartisan support, but that was linked with the $3.5 trillion spending package, which meant it didn't get through both chambers of Congress. As a result, we're still negotiating those. The likely outcome, in our view, is that they will get an infrastructure package done in the area of $1 trillion or so. And then the $3.5 trillion package is probably going to be negotiated down to something closer to $2 trillion. And that consists of new spending, but we're also going to see an increase in taxes. Most of the tax increases are going to come on the corporate side, but there will be taxes that affect individuals as well.
All right, thanks. So as we go into the end of the year, certainly at United Asset with our full financial and estate planning division, we've been looking at the possibilities of this proposal versus that proposal and its effect on corporations, persons, and now pensions. They've included some possible language that might curtail, for instance, Roth conversions within a 401k plan. We've looked at different estate tax exemption changes at different levels that they've been bantering about. So if you haven't taken a look yourself, we haven't reached out to you, please feel free to call us so that we can look at how any one of these scenarios might affect you and what planning we might be able to fit in before the end of the year. As I mentioned, it's the last quarter, and at United Asset Strategies, we celebrate each other as employees. It's Employee Stock Ownership Month. We also run a little trivia games about our company and the past. We have biggest Shredder Month, where clients, if you're local and able to get here, we're happy to meet you at your car so you can bring in things that need to be shredded en masse. We've got some secure bins that are here that are taken away and incinerated. We'd be happy to help you get rid of some of those old returns and statements that you might be hanging on to. I would like to also say that this might be our last formal recording for the end of the year, so going into Thanksgiving, please let's keep this positive momentum going, be thankful for what we have, and let's talk about it with each other. Thank you very much.